This is Badri. Uh, in this video, we'll talk about how professionals take their money tax efficiently from the property portfolio. So there are two principles to be followed to make your portfolio tax efficient. That is income tax efficient, capital gains tax efficient, and inheritance tax efficient. First one is never ever sell your investment property. I repeat, never ever sell your investment property. Second one is increase your debt as the value of the property grows. Increase your debt as the value of the property increases. Now there are people who think every debt is a bad debt. Are you the one? Well, if you have any doubts about it, there is another video that talks about the good debt and bad debt in my channel. Please go and have a look at it at a later point. So let's look at the income tax, how to make income tax efficient. Let's assume you have a £90,000 property with 67,500 mortgage on interest-only mortgage 4.5%. And after all the expenses, this property makes you around £219 per calendar month. Now, the income tax is whatever the tax band you are on. Now, for simplicity, let's ignore the Section 24 for a minute. So the tax will be 40% if you're on 40%, or it will be 20% if you're on 20% tax bracket. So now let's assume that you think debt is bad. By the way, as mentioned, there is a video talks about the good debt and bad debt. Please have a look at it later on. And you think it is a bad debt is a bad, and you want to clear it off, the mortgage. You work very hard, save money, and in 10 years' time, you clear off the mortgage. Great news, isn't it? So what it will happen? It will generate another extra £253 rental in form of rental income into your pocket. However, let's assume you are on 40% tax bracket. Then the HMRC comes along and say, hey, congratulations, you have cleared off your mortgage. And here is your reward with an extra £1,214 tax bill as an income tax. Right? So never ever pay off your BTL mortgage, buy-to-let mortgage. Instead, keep increased debt on it and invest the money to increase the portfolio faster and faster. Other thing is, always increase the rent 3 to 5% every year. People will not move out for 30 or 40 pounds unless they are going to move away anyway. So do increase the rent 3 to 5% every year. Now, due to inflation, the maintenance cost might also increase to, let's say, £90. And as inflation grows, the property value also grows. As the year goes on, property value goes on. Must have increased. And now go to the bank and ask, hey bank, can I borrow more money as property value increased? The bank will say, no problem. Your rent is increased and hence it can pay the mortgage as well. So mortgage might increase to £300. And as you can see, though you have increased the rent, your rental income stays more or less same, and hence increasing and hence no increase in the income tax. Now let's look at the capital gain tax. Let's assume you bought a property of worth 100k. In UK, on average, the property price doubles every 80 years. However, let's assume it doubles in 15 years. So in 15 years, the property becomes 200k. And the following 15 years, the property value becomes 400k. Now, let's assume that you sell the property with profit of 300k. Then HMRC will congratulate you and ask for capital gain tax. The capital gain tax will be 28%, that is around 84,000, if you are on 40% tax bracket. Otherwise, it is 18% if you are on 20% tax bracket. Now, remember our principles we talked about. Never ever sell the BT investment property and increase the debt on the property as the value grows. So if you apply those principles, one can release 300k, that is 75% of the 400k, and pay no tax on it, as we talked about earlier, as it is a borrowed money. In both the scenarios, you would end up having around 200k net, but the difference is you still own the property in the second scenario, where you applied our principles of keeping principles and keep earning rental income on it. Also, in 15 years' time, your property value doubles. Whereas on the first scenario, you no longer own the property. So there is no chance of you getting rental income or doubling the property in the next 15 years. Think about property doubles again in the next 15 years to 800k. So if you sell the investment property, you will lose the opportunity to see that kind of growth. So you got the point, right? Why one should never sell investment property. Do you know capital gain tax get washed out after death? Say I bought house 100k and it appreciates to 800k and then I die. Then my family doesn't have to pay capital gain tax on that 700k capital growth. Now let's look at the inheritance tax. Are you excited? As of today, there is no inheritance tax for the first 325k that one inherits. For simplicity, let's assume that your living house, car, and other assets take up the first 325k allowance, and kids still left with £1 million property asset. There is no debt on it. This means kids have to pay 40% tax, that is 400k. Are you aware that one has to pay this inheritance tax within first 12 months of death? Let's assume that you die in a flight or slow market and kids haven't got enough savings to pay off this inheritance tax bill. In this scenario, kids may have no option other than selling off the property, and maybe at much lower price than it is worth because of slow market. This means they lose the opportunity to enjoy the benefits of your hard work for the future growth of the property. Do you want to leave your kids in that position? Now let's look at how will it pan out if you followed our two principles, that is, never ever sell property and increase the debt on property as value increases. With these principles, you will still have 750k debt, and hence the equity is only 250k. So the inheritance tax for your kids is only 100k. That is 40% on 250,000, which is 100,000. It is still a big number, but your kids are in much better position as they have to pay much less inheritance tax in comparison. So by following two basic principles, it will be income tax efficient, capital gain tax efficient, and inheritance tax efficient. Now I know you must be wondering, yes, they are tax efficient, but where is the profit, right? Let's have a look. Here is how the professionals take the profit from their property. Let's assume you have a property valued at £100,000. Mortgage is 75,000, and your equity is 25,000. Let's imagine that property grows by 20%. That means your £100,000 property grows to £120,000, and property becomes £100,000. Now you go to the bank. Hey, property value is increased to 120k. Can I borrow more? Of course you can. And he will lend £90,000. Lender will repay existing lender 75,000, and remaining 15,000 will be deposited into your account, and it is tax free. I want you to notice three things in here. First thing, your equity increases though you borrowed more money. And second thing that excites me is the compound effect. Next time when it increases 20%, that 20% is not on the original price, that is 100,000. It is the 20% on 120,000, which is 24,000, not 20k. And you can release 18k. Next time you can release £21,600. The amount of money you can release increases over the time, and hence it is an inflation proof. Final thing is, there is no tax on the money that you release, as it is a borrowed money, and hence no tax. Now imagine you have two properties and property price increases to 20%. Then you can release 15k from each property, and in total 30k. And now you can buy third property using this money. Next time property market increases 20%, you can release the money from three properties and buy the fourth one. You can keep on building your portfolio with none of your money. Also, you need increase of only 10% to buy the fifth property, and then only the 8% to buy the sixth property, and then 6% to buy the seventh property. The point is, building portfolio gets faster and faster over the period of time. So start now. And each property valuing at 140k, in 10 years time, the portfolio is valuing at 1.4 million. We know that history tells us that property price increases 7.9% per year on average, but let's say it is 5%. You could release the 52k on your portfolio and buy 11th property, but you say, Badri, 10 is enough for me, and I don't need any more properties. I would say, well, you can still release the money and enjoy the life by spending it on car or holiday, or get retired and live on it. Also, your income will be inflation proof because of compound effect. As you can see, next year you can release up to 55,000 and so on. So follow the two principles to make it tax efficient and live on property portfolio. What are those two principles? Never ever sell your investment property, and keep increasing debt on your investment property as value grows. So, invest with knowledge, invest with confidence, create wealth. See you soon.